Thanks, bud.
All right, we only have a few more minutes here, and we're sitting here with John Vance, Vance Wealth Group, and this guy has just been sharing with you what you really need to know right now during this crazy market. We talk every week about how crazy the real estate market is and giving you insight on how to navigate through that, and John's been sharing with us things you need to really think about when you see this euphoric run in the Dow and the S&P right now, and where you should possibly be reallocating your money. And let's share something that's really fun that may excite them or scare the heck out of them regarding the sell in May, go away, those statistics since 1950. This is fun.
Okay, so what that refers to is that researchers would look back at these periods of time, and they were looking at 6-month windows. So it was May through October, and then they looked at the window November through April, and they had obviously seen a pattern, and they in crunching the numbers realized that from the May to October period, the total average return for the Dow since 1950 was 0.3%, not 3%, 0.3%. So that means if you had not been invested over that period of time, you would have missed 0.3%. However, where the returns really were made over, looking at the market over a long period of time, between November and April, where the average was 7.5%, so 7.5%. So the whole term of sell in May and go away is saying, we don't want to be in the market during the summer months when people are on vacation. There tends to be more volatility. It also includes, October has had some big market corrections in the past. So, the one challenge with this indicator is, the year everyone's pounding the table saying this is going to happen, it doesn't happen.
Right.
And so the one thing, a couple other things to know about it. If you do sell in May and go away and say I'm going to reinvest in 6 months. If you have capital gains, you have tax exposure. So that's a dangerous decision to make because that can cost you a lot of money, especially if you're a long-term investor.
Right.
The other thing is you could have transaction costs. So, buying and selling, there are fees involved with that in most cases. And so it's a real interesting phenomenon. And I've had a few conversations with clients. We work with about 120 households, and I've had 3 conversations. So, it's a small percentage, but, this is getting out there in the media. So more people are inquiring about, okay, what does this mean, and should we do it?
Okay, you want some fun? Here's a fun fact for you. Put this in. John was mentioning that the 6-month window 0.3% versus the 6-month window of November through April that returned 7.5%. Let me put it in perspective for you. If you took $10,000 and invested in 1950, and this is since 1950, right, John?
Yes.
Okay, so if you invested $10,000 in 1950 and invested only between November through April, that 6-month window at 7.5%.
The good time, right?
The good time. Everyone's always at the good time. So give you some idea, if you invested it at the end of 2011, your $10,000 would be $684,000.
Wow.
Now,
not bad.
684. Nice returns,
Yeah.
basically. Okay, so in the other context, you took your $10,000 and based on inflation and all that good stuff, guess how much money you think your money would be if you invested between basically May through October? How much money would you have? How much would that $10,000 be?
I didn't get to look at the cheat sheet, but probably $12,000.
Try $1,024.
Really? Oh, because it's inflation adjusted.
Exactly.
Yeah.
Adjusted for inflation.
Yeah.
So you actually,
I'm like, wait a second.
yeah, you have 1/10 your money versus having 68 times your money. I mean, it's a big difference. And all I'm trying to get at is not, I don't want to scare everybody going, whew, now I know exactly when to
I'm
invest.
just going to put it in my Outlook calendar.
The point is timing. And, John, you can back this up because it's where that money is allocated. And I'm not giving you any details of where that money might have been and could have been. That's best case scenarios based on just hitting that percentage over that time. But it doesn't mean you couldn't have lost because you're in the wrong segment or the wrong time or the wrong industry or whatever. The key thing is timing's everything, and that you need to have your funds allocated correctly. Am I right?
Well, it is, and the hardest thing with timing is you're going to get it wrong. And so if you don't have discipline, you may try it this year and it doesn't work, and then next year you don't do it and it does work. So it gets a little dangerous. The other thing, we don't recommend the strategy of getting out of the market. A couple of reasons. If you own any dividend-paying stocks, things that are paying dividend, if you don't own them for 6 months, you're not collecting the dividend. So you're going to sit in cash and get nothing. So you have to be careful with that because this happened the last 65 years or 63 years. It doesn't mean it's going to happen over the next 50. And so
No doubt.
this is a trend, but trends are bound to change. And so There's weird indicators where because it's May through October, it may shift. It may decide it's going to be February through August, and the market will do funny things. But timing, the allocation of your capital is the most important. I would tell you if you've had your allocation too aggressive for you and you've enjoyed nice profits, the fact that we're getting into May, you really want to look at the risk, because if you're going to rebalance, this is a great time to do it. And honestly, internally, that's what we do for our clients, is on May 1 and on November 1, we use those time frames to rebalance our accounts. We want to take a look because we know that historically that's when volatility has appeared in kind of the May through October period. So we want to evaluate it. So this is a good time to start assessing your portfolio, making sure you're not taking too much risk.
So is twice a year a good habit to evaluate your portfolio twice a year? If you're a long-term investor, is that a good number, or do you need to do it quarterly?
Quarterly is too much, just for taxes and any transaction costs. They've done a lot of studies, and the academic studies have shown that quarterly is probably too much because of those factors, and that semi-annually and annually are sufficient. It also depends on if you're adding money to accounts, because if you're saving on a regular basis, then you can just save to those areas that are out of balance. So instead of trying to change your whole portfolio, you just add more money to the kind of buckets that are maybe don't have enough in them. But so twice a year is fine. I wouldn't think of doing more than that, because then it just wastes time.
Well, okay, so you don't waste time or lose money. Make sure, John has been very nice. John Vance with Vance Wealth Group has been very nice to offer, if you mention Don and Gino, that he'll give you a free review of where your assets are right now, and give you some suggestions. And you can reach out to John very easily. The best way, I think, is just go to vancewealthgroup.com.
Just Vance Wealth.
Vance Wealth, thank you. VanceWealth.com.
Correct.
V-A-N-C-E. Yeah, VanceWealth.com. Go there. It's great information on the site. You will see that John and his team really know what they're doing. I mean, he's on top of his game. He pays attention, and he's part of our community here, reaching out to you to help you, like us, guide you to personal and financial wellness, and now's a great time to do it. Wouldn't you agree?
I think so. I mean, right now, I think people need to be a little bit more cautious. You're all feeling good. You've been getting your brokerage statements. Last year, you probably had 1 month of one down month last year, and you haven't had a down month this year. It's time to really reassess and make sure you're in the right investments.
All right. Well, thanks, John, for joining us today. I'm sorry we only got through,